Hey, welcome back to the Hub channel. I have Jeff Beamer here again with me today. Now, Jeff is our EWO senior strategist over at the EWO channel. You've been having a killer couple of weeks, obviously been crushing it with the trades, and I know we're going to dive right into last week's trade right off the bat here, Jeff. How has your week been?
Oh, it's been great. And markets are doing just pretty much what we
Yeah.
anticipated. And we'll get to the broader markets here in a little while. But let's talk about the sectors that we talked about last week, beginning with the automakers. That's where we focused on last week, kind of anticipated that these would go sideways, possibly even trade a little lower. And you can see Ford here, past 5 days, past 6 days, it's moved dead sideways. And General Motors is the one that I isolated on, said, hey, we're going to do a sideways trade on GM. So if you know how to trade delta neutral style trades, then this is what we would apply to a stock like GM. So if we pull up that trade, as you can see on GM, we did what's called a calendar spread. And this spread is up almost 40% in 1 week. Okay, a basic calendar spread. You buy a longer term option, you sell a nearer term option at the same strike price. And you can see that this stock is up about 40% in 1 week. Amazing thing is that we are right at the strike price that we selected, $33. You can see last week stock dropped a little bit, and today General Motors rallied up almost 2% on the day, and now it's pinned right at 33 with only 4 days left before our short option, the option that we sold, before that short option expires. So this could be potentially a really nice return on investment. The trade itself could generate up to 250% return on risk. And while I don't anticipate making all that money, we are sure enough in a good spot with only 4 days left in the trade. How about that, Brandon?
So you feel comfy in holding this trade right now. You're going to still hold this thing. You have 4 days left before it expires, and you're in a really good spot. And I know you've hit in the last few trades like this with minimal risk, Jeff. This has been doing really well for you. So how much longer do you think you're going to hold this trade? Maybe 2 days, 3 days? What are we thinking?
Maybe 24 to 48 hours. You know, as far
Okay,
as
right on.
two trading days, essentially,
Yeah.
is probably out by Wednesday before the Friday expiration of that short option. Yeah, most definitely. Yep.
All right. Well, that looks good, Jeff. What else do we have going on?
Well, let's take a look at some top headlines here. One of the main headlines that we had today were treasury yields. And, you know, man, treasuries continue to move higher. We have the long end of the curve, which is the 10-year. Man, it is screaming higher. And you can see here in the 10 to 3 month treasury yield spread, the good news is the spread is what we call flattening. The bad news is the 10 years are screaming higher, which is pushing all long term rates higher. Okay. So it's a pretty dramatic shift. We're well off the lows of the spread, but the fact that we're still inverted is a big problem. I'll talk about that more in just a moment and why that's a problem. But the fact of the matter is, interest rates overall are screaming higher. And if we take a look at the 30-year interest rates that deal with mortgages specifically, you can see that we are back up to 7.5% on average for a 30-year mortgage here in the US. Now, that is up dramatically in 1 week, really a 25 basis point in mortgages. Either way, up or down, is a dramatic move when it comes to bonds, when it comes to mortgages. And that's part of the volatility we've been seeing in these markets that deal with debt or credit. Okay, the crazy times right now in this sector. Now, that inverted yield curve, the problem is that historically, when bonds or invert, meaning the short end becomes higher in yield than the long end of the curve, that is an early sign of inflation. Now, I'm not a big fan of many economists. In fact, as a market technician, we joke that if you spend 15 minutes talking about the economy, you've wasted 10 minutes of your life. But there are some economists that I really do like and I really do follow. And one of them is Peter St. Ong. That's Saint Ong, Onge. I'm probably butchering that name. It's probably Ongi or something like that. But I've listened to him for quite a long time. And he is what's called a mainstream economist. Now, mainstream economists are paid to use, they're really looking at historical data, like hundreds of years of data and economies on different markets, okay, rather than a classical economist. Well, that's what Peter is. A mainstream economist uses kind of like government numbers and whatever their firm says they need to publish and what their firm says they need to look at. So Peter is what we call more of a classical economist. Sorry if I got those two backwards. And what he is essentially saying here is, when is the crash? And quite frankly, as the headline reads here, and this is from his notes over the weekend, 300 years of central banking says it's a matter of months. And that's what that inverted yield curve has been telling us for over 6 months. Okay, the 2 and 10s, it's been almost a year. In fact, it's been over a year that's been inverted. That is telling us. And the image that Peter put into his publication was published by the conference board, which generates. This is a nonprofit, non-political organization, and you can see here every time we get this in kind of inverted yield curve, or that we have GDP acting a certain way, you can see that the economic indicators in this chart are back down near that zero line. And what happens when this is as of February this year, okay? So when we drop below that line, we get a recession, and we have been there now for 6 months, okay? So as Peter says, hey, it's getting to where we might see a bad inflation. And that should just tell you that you should really focus on um, uh, sectors and publications that really can add to your bottom line, that are adding value to your bottom line, which is what we tend to do here on this channel. All right. So with that, let's
This just goes
jump
to show. I
ahead.
mean, obviously, it's a matter of when, not if, right? Or matter of when, not if it's going to happen. So
Historically,
it's going to happen. It's just, bam, get ready for it.
historically, yes. It's not a matter
Yeah,
of if, it's a matter of when. And the
that's right.
bond market, the bond guys are, some of the smartest next to option traders. They're some of the smartest in the room. And that's always
Right.
been a leading indicator when it comes to inflation. Yes.
Yeah.
Yep.
Okay.
So with that, let's look and see how all this is impacting the market. Beginning with, we'll jump over to SPY. We'll take a look at the broader market and what just happened today. And you can see that we have this, what we call an ABC pattern forming. Well, it has formed in this little move. We had that, what we call an A move, and then we have this B move here, and now we have this C move coming down. All right. And, have we reached major support? Well, we have. Okay. 430 has been my target for months. I'm officially on record. When we were early days of appearing on this channel, I talked about 430 was my target. We got close back here in August, didn't quite get down all the way to 430, but we not only got down to this level, but we pierced it, and now we're holding at 430. This is a critical level of support for a variety of reasons. Now, technically, you can see here if we draw that in, if we break this level, we could go back down to 410 to 400. Okay, a colleague of mine, in fact, Rob Roy, has a target of 420. Well, if it breaks 430, it's definitely going to 420. Okay, before it moves any higher. Now, how do you manage this? Well, you can simply put a line in the sand. I'm going to take that trend line and move it over. You could essentially just draw a line in the sand and say, hey, I'm going to be bearish or protect my portfolio until we cross whatever line you draw to the upside. And that's kind of how to play this right now. Right now, it's bearish, but we're at support. If we break this with any type of volume or technical type of candle, we're headed down, and we could see 410 to 400 by November, really, is how bad it's gotten. Now, we did rally today. We're holding back up at 430. The NASDAQ, the tech-heavy NASDAQ, is kind of in the same situation. Very similar chart, okay? Has that ABC pattern going on, and then we have significant support here at its current level of 360, okay? Holding right there. And again, it's a significant level of support. How do you play this? Well, again, you could put your moving averages on as an example and say, okay, when it crosses my short-term moving average, in this case, I have a 21 period moving average. And when it crosses that, then I'll go long again, or I'll take my hedges off my portfolio. Okay. That is how to play this market right now. And right now, it is getting a little concerning, especially when it comes to the small caps. All right. Now, the small caps have been leading the markets downward. Had a good day today, okay, stopping at 177 on its way down. Looked scary this morning, but rallied up throughout the day, closing up about 46 basis points. So it's holding this current level, which is where all the support is. Okay, all the support is in this area down here, and we'll just draw a little trend line. Refresh my screen here so I can draw my trend line. But once we draw that trend line over, you'll see it acts as major support. Okay, so we'll just take this here and this level here, right there. All right, so we have this action here, significant level of support. Now, there is major support on IWM, probably another 10 handle to the downside. Maybe, that's a 5 handle right there. 5 points to the downside. But if we drop below 170, which is just 7 points away on IWM, it could get really ugly for the broader markets. Right now, I'm not too worried. We're at major support, but this week will tell us a lot. All right. So just a couple of others here real quick. We have USO. Energy has rallied up. It's kind of leveled off at its current levels. Okay. And crude oil could definitely take a run towards 100. USO was down 31 basis points today. Crude oil is trading around $90. But that 100, it's sniffing that 100 level, and sure enough, could get up there. XLE was up 1.23%. You can see my little actually, this is minor support here. I drew this trend line a little earlier today. It held support. All right. And as long as it stays within this channel, energy is moving higher. Now, if it breaks this channel, we have a little bit of support down here around the $85 level, $86 level. But then if it breaks down below there, it's going down to definitely 80, if not 75. That would be good news as far as maybe energy prices go overall. But right now, it's in a definite uptrend, and it's definitely causing some problems. All right. And lastly, we'll take a look at the bond market. I talked about bonds and interest rates already, but here's a chart of the 10-year dropping like a knife. Okay. You do not want to stand in front of this. Okay. If you're a bull, all right, interest rates are dropping or are rising. Sorry, bonds are dropping like a rock. Okay. So, yeah, you're getting a better interest rates, but why on earth would you put your cash in bonds when the bond itself is losing value? Because it'll lose value faster than the interest rate can make up for that, So people are moving out of bonds into equities. That's what it's helping support equities, why they probably haven't fallen off a cliff yet. But that's what we're seeing overall. The short end of the curve, you can see that the 10-year was down over 74 basis points today, when the 2-year, the 1 to 2-year, look how flat that is. Look how flat that is. That's why that yield curve has been flattening, and the 10-year is catching up to the 2-year, but it's not it's not there yet. We are still inverted, and that's a problem for the broader markets. So, lastly, we'll look at, let's take a look maybe at GLD real quick, and where gold and some of the metals are, and see if that's telling us anything. And no, gold is stuck in a range, moving sideways. In fact, we have what appears to be kind of a technical pattern developing here that could be a little breakout either direction, going into that little wedge. And the way that gold feels right now, it feels a little heavy. I would say the potential for a breakout to the downside is greater than the upside, but that also depends on what the dollar's doing, etc. So that's our our market update for today. Let's take a look at our earnings calendar. We have a couple of stocks that we're in the quiet end of the cycle right now. As stocks go through their quarterly earnings, there's some ebb and flow to the number of announcements that are generated. And right now, we're on the quiet end of that. We won't get into the heat of earnings season until about the third week in October. But even now, we have some names that are recognizable. Okay, you have tomorrow after market close, you have Costco that has earnings announcement on Wednesday. Not much, there's Jefferies as far as a financial firm goes. They're a big player in the financial sector. But it's really Thursday when we have CarMax in the morning, Nike after the close, BlackBerry after the close, and then finally on Friday, Carnival Cruise Lines. Okay, so we do have some notable names, but nothing that we would necessarily play to for a breakout strategy. And Brandon, our breakout strategy has been performing phenomenally all summer long as we went through that last earnings cycle. We do have a document that you can download to see how we trade straddles. It's a free download to understand how to trade this very basic and simple strategy that seems to cause people a lot of problems, honestly. And it's because they don't pick the right stock or the right expiration, okay, when it comes to options, when it comes to that strategy. So I have this document, I have this ebook for you, simple download, several pages long, but I go into detail of how we trade these straddles around earnings. Earnings are coming up in just a few weeks. It's a good idea to not only download a copy of that, but to subscribe to this channel, because we'll be talking about it more when we get to those dates. So what we're going to focus on here as we close out our session today really are on stocks that continue to be quiet. All right. Stocks that just really aren't moving. And I have a stock here that meets that criteria, and that happens to be Philip Morris. All right. PM is the symbol. All right. Philip Morris obviously been around for a long, long time. And you can see here that the stock is stuck in a range between $90 and $100. So when you are owning a stock like this, it can be absolute misery. It's adding nothing of value to your portfolio. And please don't say it provides a great dividend. Okay. I won't
I was
get
just
on a
gonna say that,
soapbox.
Jeff. Gosh dang it. That's where it was
Don't-
around. Honestly, it was on the tip of my tongue. I was just looking up the dividend and what it's paying out. It provides a great dividend, Jeff. Come on. What do you got for me, bud?
I
So
mean,
no.
don't get me on my soapbox about dividends. Okay.
Okay, I'm sorry. Get off that soapbox. Let's
Let
keep
me
going.
just
What do we
leave it
got?
there. What you want to do with a stock like Philip Morris is learn how to trade a strategy sideways. Okay. Whether that be a counter spread or an iron condor or a butterfly or a condor. Those are the type of strategies that take advantage of stocks that are in that quiet pattern. Philip Morris fits that bill. You can see that really since April, the stock dropped down into this range and has just been oscillating between that $90 and $100 range and is ideal for this type of sideways strategy. So, like GM, next week I'll show you what we did. Okay. Subscribing to our Delta Neutral Trader service gets you alerts like this in real time, up to date, sent to your email and your phone. And I'll show you exactly how to take advantage of stocks like this that are really going nowhere. Perfect style of trading right now as there's so much indecision in the markets, Brandon.
No, I like that option, both the sideways strategy because we have been trading the breakout plays, but now we got some sideways action on the board, and a lot of us don't know how to trade it. So, perfect solution right here. Obviously, sign up. Download Jeff's guide. It is perfect to help illustrate all of these straddles and other things Jeff's teaching to help you along with this stuff as well. Jeff, as always, thank you again for dropping by the channel today. You've been crushing it on your trades, and I can't wait to see next week if you've crushed it on Philip Morris yet again. Thank you so much for stopping by the channel. And
Have a
as
great
for the
week.
rest of you guys, be sure to subscribe, like, and comment below if you have any questions. Jeff's here to answer those questions, and we will see you in the next one.